Welcome to day 3 of our Christmas countdown series. We started with the global economy, moved to interest rates, and today we open the window on the bond market. After the next 25 basis point cut from the Fed, which is expected tonight, markets are pricing another 75 basis points of easing over the next year. Bond markets seem pretty relaxed about that story. Treasury yields have recently been stuck in a tight range around the 4% mark. Corporate bond spreads, meanwhile, starting from already tight levels, have actually tightened further. Put together, the Treasuries and credit markets are effectively saying, don't worry, this is a gentle Goldilocks slowdown. And we think that's too calm. As we discussed yesterday and day before, we see above average odds of a sharper slowdown and a higher chance of more rate cuts than the market's currently expecting. And not because inflation has been perfectly beaten, but because growth weakens. And in that world, high quality and duration, especially treasuries, can do well acting as portfolio insurance. Credit's a different story. A relentless search for yield has led investors to take on more risk, especially credit quality. But after 5 years of outperformance versus treasuries, and with spreads near cycle tights, the asymmetry is building on the downside. Any credit deterioration can push spreads wider from very tight starting levels, negating the impact of falling interest rates and making the asset class vulnerable if the growth narrative cracks. So, our bond takeaway. We like treasury duration as protection, but we're cautious on broad corporate credit at these valuations. Come back tomorrow for day 4 when we discuss FX. This is Sunil Garg from Keen Eye and Lighthouse Canton.